Hi, welcome to Think Beyond the Keys. I am Melvina Fredson-Cole, and yes, I'm not live, but I'm still bringing you the same awesome contents in real estate. I hope you're having a great week. This week, I'm going to speak about FHA loans. I know you've heard about it. A lot of people know a lot of information about it, but I'm going to give out like a broad overview of what it is exactly. Now, FHA stands for the Federal Housing Administration, and it was formed in 1935. Back then, the Great Depression, it was formed in 1934, sorry. Back then, the Great Depression, things were not looking good for everyone, and real estate was no exception. About 2 million construction workers lost their jobs. I mean, lenders were not lending, and even if they did lend to buy a home, they asked for 50%. They only loaned 50%, and then you have to come up with the other 50% down payment of the home. So you can see right off the bat that that was not great at all. And in addition to that, borrowers, the term of the loan was only between 3 to 5 years. And at the end of that term, they had to pay the whole sum. So there was a balloon payment at the end of that term. So those terms were not really great. So the government looked at it and said, okay, we need to boost something up. And in addition to that, the government found out that only 1 in 10 households really owned their homes. So 9 out of 10 people were renting because they couldn't afford that. That was really ridiculous. So what did they do? They formed the Federal Housing Administration, which is really cool. However, Federal Housing Administration, FHA as we know them, they do not give loans. What they decided to do, they decided to insure loans that lenders give out. So they come up with this criteria and said, this is the type of borrowers. If you loan them money, we would insure these loans. And so that's how we got the FHA insured loans. However, they did not take taxpayers' money. I think that was also brilliant. They decided the program to fund itself. So it is a government agency, but it is not funded by taxpayers. So what they did is that each borrower that is qualified for the loan, they attach premiums to it. So the premiums that these borrowers pay, I know you've heard of it, of mortgage insurance. The premiums that these borrowers pay they go into the bucket, into FHA bucket, to run the program and to pay out claims if a borrower defaults. So if a borrower does not pay their loan and goes into foreclosure, what happens? FHA, the lender would send a claim, and FHA would pay a certain percentage of that loan to the lenders. Now that makes the lenders a little bit more receptive to start borrowing and start boosting home ownership in the United States. So that is FHA. And I think in 1965, I guess, was it 1965? Yes, it came under the, was it 90? Yeah, sorry about that. 1965, there's so many figures in my head. The Federal Housing Administration came under the Housing and Urban Development that we know as HUD. So now the insurance premium, what does that mean to you? It means that, like, if you're going to take if you qualify for an FHA loan, because remember, loans, mortgage loans, I look at them like they are something like a mortgage currency, that you have to have some type of mortgage in order to purchase a home if you're not paying cash. And a lot of people don't have cash to buy a home. So they use these mortgage currency, they use these products to purchase a home. And that's all there is, what is mortgage. And each of them have their own criteria and have their own stuff. So if you go for a FHA loan, what happens is that you have to pay a premium that is added. There are 2 types of premium that an FHA carries. Yes, 2 types. The first type is an upfront mortgage insurance. And that is something that you come up, and it's currently at 1.75% of the loan amount. Now, because a lot of people don't have that money, and they understand that, with closing costs and the prepaids you have to do, of purchasing the loan, they allow you to roll it into the loan. So you don't have to come with that money up front. So that's one type, 1.75%. Remember, these premiums go towards running the program and paying claims, right? Because the FHA is funded by that, and it's not no taxpayer money. The program is. And so the second premium that is paid by the borrower is called the annual mortgage insurance, and that one is not paid annually. What they do, they divide it into 12 months, and then it's added to your mortgage. So when you pay your mortgage, a certain percent go to the principal, interest, you know, if you have an escrow account, insurance and taxes, and then the mortgage insurance. So that's how that is broken up into, and the lender, they send that portion, that premium to FHA that goes into that bucket. Okay, and normally for FHA loans, that premium is unlike the private mortgage insurance, which is for conventional loans and other private loans. If you do not come up, if you come up with less than 20%. So remember, mortgage insurance is paid if you come up with less than 20%. You are higher risk to the lender, and if you default, they tend to lose. So that's why they have that insurance. With FHA, they have that mortgage insurance, and they do not, like the private mortgage insurance, non-FHA loans. What happens is when you get to that 20%, that 80% loan to value, it automatically drops off, or you have to call the lender to say, hey, now my loan, I've paid 20% of it, I don't need to pay the mortgage insurance anymore, and they need to drop it off, right? Well, with FHA loan, that is not the case. It is paid for a period of time, typically 11 years or to the end of the loan, because FHA loans, their term is only 30 years or 15 years. Those are the only two terms that they have that you should pay their mortgage. So normally most of the mortgages are for around 11 years, and give or take, it just depends, okay? And that's how it is calculated. And also the monthly, the upfront mortgage insurance is a flat fee, is 1.75%. However, the annual mortgage insurance that's divided and added to your mortgage, that you pay those premiums every month, that one is, if you come up with less than 80%, it's normally 0.85, but it ranges up to 1.05 from 0.45. And the reason why, in everything, it depends. It depends on how much down payment you're putting in. It depends. Some people put 5, 6, 7%. It depends on your credit, your FICO scores. It depends on the length of the premium, if it's 15 years or 30 years. So they have a table where they calculate how much insurance premium you are going to pay. Okay. Now the FHA also has other guidelines, you know. Just like any other loan, they have certain criteria. One of them is FICO score. Now, if you remember, I spoke about what lenders look for in order to borrow buyers, in order to lend buyers money to buy a home. And I also have that in my link down there. You can check it out. But they do have that. And one of the things is FICO score. And FICO score, most lenders, conventional, Fannie Mae, Freddie Mac, and others, they at least 620, a 620 FICO score. Now, FHA looked at it like, oh, want to help people to get their credit, but however, that 620, a lot of people fall below that. So what they did, their FICO score is below that. So they require a 580 credit score if you're putting down at least 3.5%. So you have to put down at least 3.5% and have a 580 FICO score. However, if you have a 500 to 575 FICO score, you can have an FHA loan. However, you have to put 10% down. So that's one of the ways that they helped people, because really a lot of people, some things happen in life and you have to start building, and it is a shame if you have to wait years and years and years to get to that point. If you know, to rebuild, you rebuild faster if you build wealth faster, right? And so if you become a homeowner early, you build your wealth faster, and you could get out of that low income, low credit score. So that's for that. And then another criteria they looked at, they said, okay, in conventional loans, they look at the debt to income ratio. I spoke about that before in what they look at, and they look at the debt to income ratio. I'm sorry, that's my phone. We're going to turn it off. But the debt to income ratio. And so for conventional loans, the mostly Fannie Mae and Freddie Mac, that's the mark that most lenders use. Freddie Mac has a front end, Fannie Mae doesn't. Freddie Mac has a front end ratio of 28%. So what does that mean? It means that if the front end is how much of your income monthly is going towards your rent, your mortgage payment, how much will that be? What percentage of that will that be? And it has to be at least 28% and below before they'll borrow you. And they have a back end ratio, which means that how much of the mortgage plus all your debts, they run your credit so they can see all your debt, your credit, car payments, whatever you have, student loans, all of that, they add those monthly payments, and it shouldn't be more than 36% of your income. And so FHA looked at it like, how are we going to help some people? And FHA is really cool because I think they have the highest back-end ratio on all the government loans, because even VA has a 41% back-end ratio. They have no front end, but back-end ratio. Remember, back-end, your mortgage payments plus your revolving or installment. That means if you have a car, if you have a student loan, if you have credit cards, those balance what you pay every month, all combined with your house payment, they take it, add it, and work the percentage of your income, and that's what they call the back end ratio. And VA has 41%, but FHA has up to 43%. So that is awesome. That also helps people to rebuild faster. It's a 43% for FHA. They also do have a front end, which is 31%, which is pretty cool because Freddie Mac has a 28%, but Fannie Mae only has a back end, but they have a front end, and that is 31%. So they made it being like, if you're outside that conventional, the norm, you can have a home. You will be able to afford a home. That makes sense. Obviously, the residents have to be your primary residence in order for you to qualify for this type of loan, and you should have work, and you should show that you will continue to be, you will have ongoing employment and be able to afford it, because this is an insurance program basically when you look at it. And obviously they would not be able to sustain the program if they're having high claims, because only money that is paid, they pay out, just like an insurance company. Now, remember last week I spoke about conforming and non-conforming. I'm not going to go through that. Click the link down there. I put it down there for you. But FHA do have their own minimum loan that they will borrow, and a maximum, like a floor. This is the minimum we can lend, and then this is the highest we can go. Does that make sense? So the minimum, normally what they do, they use the national conforming loan that I spoke about last week. They use 65% of that to start their floor level. So the conforming loan limit, I spoke to you about that last year, beginning 2021, because it's adjusted every year depending on how home values rise or whatever it is they adjust it. And so it's 548, 250 starting in 2021. FHA took 65% of that, and so that is their minimum. And it depends on where you are in the country. They know home prices everywhere, so it starts from so FHA's own floor level minimum is 300, conforming, what they call conforming, it has to be 356,362. Anything above that is non-conforming for them in areas where there are low-cost homes. Now, in areas where they're high-cost home, again, they use the national conforming limit of 548,250, and they use 150% of that, which is, I think they come to 156% of that. This is 822,375, and that's on high end. Here in California is considered high end, and I think Florida and New York and other areas, there are a few areas. However, just to know, if you're in Hawaii, Guam, Virgin Islands, or Alaska, They know that those places they're really high end, and they have a separate amount for you guys, and that I think is 1,233,550. 1,333,000, because they know that those areas are really high cost, high level, and the homes are really expensive. So those 4 areas, they have a special limit for you. And that, remember, the Virgin Islands, Hawaii, Alaska, and Guam. That those areas, they have a different one for you. So that's what I have for you today in FHA loans. If you want to learn more about that, DM me, let me know. I can sit with you and go through everything. And just a quick note, FHA also have a home improvement loan, which is called a 203K, and that's mean if you're purchasing a home and need to fix it up a little bit, you know, let me know. I can help you explain that and see if you qualify for that. And they have that, so you can purchase a home that needs just a little bit of fixing, and all that is rolled into the one loan that you pay. So I hope you have a great week. I hope you learned something from today, and I'll see you next week in Think Beyond the Keys.